Hey everyone, welcome back to Corporate Decoder, the place where we decode the stories hidden inside corporate filings. And let's just say this filing might have some interesting moves to unpack, perhaps even a few shell games. So today we are diving into Tharimmune Inc.'s latest filing, a company that seems to be making some serious plays in the market. We will break down what exactly they are up to and what it means for their future. Before we deep dive, make sure you are subscribed for more simplified corporate insights and join our Discord community for real-time discussions linked in the description below. Alright, so what we have here is a Form 8K, a document companies file when something big happens, something that investors need to know about right away. Think of it as a company hitting the newsstands with a major announcement, but in super official legalese. The company in question is Tharimmune Inc., and it looks like they have been very busy lately. This report details a significant event for them, a securities purchase agreement, which essentially means they've been raising money and making deals. Now, while the incorporation details like being a Delaware company with a specific file number are important for regulatory tracking for us, the real story is in the transactions they are making. Tharimmune trades on the Nasdaq Capital Market under the ticker symbol THAR. This tells us they are a publicly traded company and their shares are available for anyone to buy and sell on a major exchange. One detail that frequently pops up is whether a company is an emerging growth company. This classification has some implications for reporting and how much flexibility they have with certain financial rules. Tharimmune checks this box, meaning they might be a younger company or one that is still growing into its full reporting capacity. The main event here is under item 1.01, which covers the entry into a material definitive agreement. This is where they disclose their big deals. On July 23, 2025, the company entered into a securities purchase agreement. This is a fancy way of saying they made a deal to sell more of their stock. They did this through a registered direct public offering, also quite a mouthful. So what did they sell and for how much? Well, they raised a total of $1.74 million. This money came from selling their common stock and something called pre-funded warrants. Think of a pre-funded warrant like a special coupon that allows you to buy a share at a set price, but you get it immediately. They sold over 4,400 shares of common stock and over 500,000 of these pre-funded warrants. On top of that, they also sold another type of warrant called a common warrant in a private deal. These common warrants let the buyer purchase shares later at a specific price of 1.66 per share. The total package, meaning a share or a pre-funded warrant plus a common warrant, was sold for $1.786 each. This is a common strategy to make the offering more attractive. You get a share and a ticket to buy more shares later, all tied together. The explanation for how they could sell these securities is through something called a shelf registration statement. Imagine a company gets pre-approval from the SEC to sell stock whenever market conditions are right. It's like having a shelf stocked with securities ready to go. This particular shelf registration statement had been filed earlier and was effective. When shares are offered this way and registered, they have to provide a prospectus supplement. This is a document that gives more details about the specific offering. It's a key part of securities law, ensuring investors have the most up-to-date information. Here's an interesting twist. The common warrants and the shares that these warrants can be converted into were not registered under the Main Securities Act. Instead, they were offered under specific exemptions like Section 4A2 and Regulation D. These are often used for private placements or offerings to sophisticated investors and generally mean fewer disclosure requirements initially, but the company promises to file a resale registration statement later to allow these to be traded. The deal itself was finalized on July 25th, 2025. So in the span of just a few days, the company structured and closed a significant financing round. To get this deal done, they hired an investment bank, or rather a placement agent, President Street Global LLC, to be their exclusive lead agent. This means President Street helped find the buyers for these securities. Now, of course, President Street gets paid for their services. They are getting a fee of 7% on the money raised from selling the units and another 7% on money that comes in if and when those common warrants are exercised. A 7% fee is pretty standard for this kind of placement agent work in the investment banking world. The report mentions all the nitty-gritty details of these agreements. The purchase agreement, the placement agency agreement, the forms of the warrants are all attached as exhibits. These are the full legal documents that govern the deal. They also include an opinion from a law firm Lukowski Brookman LL. This is basically a legal confirmation that everything is on the up and up and the shares are validly issued. It's a stamp of legal approval. Moving on to item 8.01, which covers other events. On the same day the offering pricing was announced, they also put out a press release. Companies always do this. It's their way of communicating directly to the public and the media about major news like this fundraising. The press release is included as an exhibit so we can see exactly what they told everyone. And finally, item 9801 lists the exhibits filed with this report. This section just confirms all the documents we've talked about are attached, including the forms of the warrants and the placement agency agreement. It's like a table of contents for all supporting evidence. But of course, the report is signed off by company executives. Here we see Suresh Apahasa, the Chief Executive Officer, giving his authorization. This signifies that the company stands behind the information provided in this filing. The report itself is dated July 28, 2025, meaning it was filed just a few days after the most significant events took place, documenting the entire process. Overall, Tharimmune Inc. has engaged in a significant financial transaction, raising nearly $2 million through the sale of stock and warrants. This is a common strategy for companies, especially those in growth phases, to secure capital for operations, research and development or expansion. The use of pre-funded warrants and regular warrants allows them to raise money now and potentially more in the future if the stock performs well. The dual approach of using a registered offering for some securities and private placement exemptions for others is also a strategic move, balancing regulatory requirements with market access. Now, let's shift gears from the mechanics of the deal to what it means for the company and for investors. Raising capital is almost always a positive sign that a company has plans and needs funds to execute them. For Tharimmune specifically, given it's an emerging growth company, this capital infusion is likely critical for its development. The fact that they are using a shelf registration suggests a degree of forward planning. However, the reliance on warrants and private placements also means that future dilution of existing shareholders is a potential concern as these warrants get exercised. The pricing of 1.786 per unit and the exercise price of 1.66 for the warrants gives us some clues about the company's perceived value and the market's appetite for its stock. For investors, it's crucial to understand that warrants are essentially options to buy stock, and they can impact earnings per share when exercised. The pricing of 1.786 per unit and the exercise price of doing business that reduces the net proceeds from the offering. Considering the information in this filing, Tharimmune is actively seeking to fund its growth. The success of this financing round will hinge on how effectively they deploy this capital to achieve its strategic objectives. We need to keep an eye on their future performance to see if this investment translates into tangible business growth and improved financials. Risks for a company like this typically include market volatility, the ability to execute its business plan and competition. The success of warrants is also directly tied to the company's stock price performance. If the stock price stays below the exercise price of the warrants, they might never be exercised, but if it surges, the company receives more capital and existing shareholders might experience dilution. It's a delicate balance that growth companies are constantly navigating. Alright, that's our breakdown of Tharimmune Inc.'s recent filing, ensuring you understand the core of their financial maneuvers. What's your take on this fundraising strategy and what it signals for the company's future? Drop your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and remember to subscribe for more simplified corporate deep dives. Don't forget to join our Discord community linked in the description for more of these discussions. Thanks for watching. See you next time.